Hi everyone. So 10-year yields unchanged on the week at 4.25%, while stocks fell 2.1%. So we have risk markets and corporate America broadly taking a hit here. And now let's jump right in. So Monday was your classic risk on move. You have selling pressure in safe assets like treasury yields, and you have a rally in stocks. So your sell-off in treasuries just means yields are going higher. And the simple explanation is you have positive tariff headlines over the weekend, with some of them signaling that the scope will be narrower than expected. So that's how the markets reacted. So that's very simple. Risk on. On Monday, you'll see both lines moving higher. So now let's move on to Tuesday. You have yields rallying lower, mostly in the New York hours. It's not really much of a good story here, but consumer confidence did come in lower than expected. Stocks saw a bit of a late day comeback rally and ended a little bit higher, powered on by the mega cap big tech names. Okay, now let's keep breezing through. Wednesday, we had yields in reverse. So they're selling off higher, back from what happened on Tuesday. Not good stories here either, but we had Fed speak talking up inflation and some positive economic data. And so just another quick aside, anytime Fed speakers are focusing on inflation, talking up inflation, that's hawkish. So that's something that can add fuel to higher rates. And on the other hand, generally, a data beat would tend to reinforce positive economic expectations. So that can also be another driver of higher rates. And in market lingo speak here, beat is just data coming out better than expected, and the miss is market data coming out worse than what the market is expecting. So on the equity side, stocks fell as they braced for more negative tariff headlines, because on Wednesday, after the market, it was expecting Trump to sign in 25% of the auto tariffs. So let me back up quickly and just talk about tariffs for a second here. So you can think of a tariff like a tax, and specifically an import tax. So an example I came up with is Nike selling shoes. So let's say Nike sells shoes in the US, but it gets rubber for their soles by importing it from Thailand. So if there's a new rubber tariff tax in place, that means Nike now has to pay more for rubber. So Nike's costs just went up, so that puts downward pressure on its profits. Or Nike could try to keep profits the same, but what it would have to do is raise shoe prices instead to offset higher input costs. So in this case, consumers would have to pay more for a new pair of Nike shoes. And when you look at it either way, economic growth or activity takes a hit in the form of lower corporate profitability or higher consumer prices. So that's a quick tariff guide in a nutshell. Now, Thursday was mostly noise, a round trip move in stocks and bonds ending up where they started. So let's take a look on Friday. I think Friday is arguably the highlight of the week. Action all in the New York session. We have classic risk off here. So your safe haven assets like treasuries are doing well with yields falling while stocks are getting hammered. And the mood of the market here is stagflation worries. And stagflation is a combo word of one side being stagnant or no growth, and the other side being inflation. So that's a double whammy there for the economy. So let's look at the stag part in stagflation. So we had a GDP now, and you can think of that as a real-time estimate of economic growth. So that data point got a new release, and it printed more negative after factoring in the latest data from Friday morning. And looking at the inflation piece, we have core PCE that printed a little bit higher than expected. So that's two sides of your stagflation coin. And then there's the last piece, adding fuel to the fire. The risk off fire is your monthly University of Michigan consumer sentiment. And that also came in weaker than expected. So another sign that consumers are gloomy about the economy and overall conditions. So there you have it. That's the week. Thank you for tuning in and see you next time.